Hi, this is Shreya, and today me and my teammates are going to be discussing on the topic Fintech plays an important role in democratizing finance, but it sometimes creates new problems. So let us first look at the role of fintech in democratizing finance. So we know that the introduction of fintech in the field of finance sector has led to cost reduction, better services to the customers, less time involved in providing these services. But as a result of say cost reduction, all kinds of financial services that were only available to a certain class of people, say the wealthy class, before has become available to the normal public, the middle class public, and the poor section of the society. In other words, the democratization of financial services has been achieved due to the technology. The advantages of automation is not just to lower the cost, but also to extend convenient tools to the normal public. For example, say robo-advisor. Now, robo-advisor is a very new term that has been come into the picture because of the ever advancement of the technology. Now, robo advisor is somebody who's not afraid of fatigue. Now, earlier, when there were traditional banking services, uh, they could only target a certain section of the society. Now that the technology has advanced, it just not just targets people near the top of the pyramid, but it also includes people at the bottom. So this has in some way led to the democratization of finance. Now, some of the driving forces propelling fintech forward includes data and AI, APIs, payment innovations, transparency. Now, data and AI has been very helpful in collecting and analyzing massive data sets to achieve better target opportunities and avoid pitfalls. APIs is very helpful in integrating services from multiple sources into a cohesive single offering, um, which has actually led for the fintech new startups to be very appealing to the audiences. Now, payment innovations, digitalization transactions for more straightforward and less expensive payments while also enabling more complex payment models like payment innovations, for example, Apple Pay, Google Pay. Then the transparency, traditional banking services, the main thing that they lacked was transparency. Now, fintech has led to more transparency, improving methods to monitor, audit, and access marketplace participants to advance trust in the system and encourage participant responsibility. So we already know that how important role does fintech play in democratizing finance. Now let us see how new problems are caused by fintech. So the first one is data security. Data security has always been the major concern in the internet world, um, be it mobile banking, payment apps, or fintech in general. It has always been there. The problem of data security has always been there. Then the compliance with government regulation. Finance is one of the most regulated sectors. There will always be interference from the government, even if you leverage the traditional fintech software that doesn't use crucial technologies. Then big data and AI integration. Fintech organizations face various challenges to implement these technologies. They require expertise and constant maintenance. It is not very easy to integrate and adapt to these latest technologies in the existing system. Implementing this will require not only technical adjustment but will reshape the business and require adaptation for the existing banks or corporates and their audiences. Then blockchain integration. Um, you can make a fintech industry more trustworthy by implementing a blockchain, as it allows to analyze and track all the phases of a transaction and prevent any changes to it so that you can always have an eye on it. However, integrating a blockchain is quite a challenging task for many financial organizations. It's not very easy to adapt to. Now, the other problems that are caused by fintech is user retention and user experience. For the fintech sector, user retention and user experience are one of the major concerns. However, fintech applications should manage a balance between user experience and security. For example, they should create a mobile application which also involves banking services that is neither easy to break nor too hard to access, that will lead to retaining more users and enhancing their experience. Uh, Next is effective marketing tactics to acquire customers. Generally, fintech organizations fail to understand their niche, target audience, and strategies. In recent times, where most people still use traditional banking services, fintech companies find a hard time overcoming this challenge. So they need to find more better tactics, marketing tactics. The last problem is personalized service. Personalization means interacting with the user at the right time on their preferred channel with a proper solution to their exact needs. Besides, customers are open to accepting fintech as their financial wellness coach. Some users may feel overwhelmed with a wide spectrum of options. So, personalized service, which is a very unique thing about fintech, can actually become a problem as well. So, further, we're going to be discussing and analyzing deeply the first four problems that we discussed. That was data security, compliance with the government regulations, big data and AI integration and blockchain integration. So my teammates would be continuing from here. So the thesis or the main argument of our presentation is going to be, even though fintech has demonstrated an instrumental role in democratizing finance, there are still developments that create new problems. So widely we'll be discussing and critically analyzing the following areas or problems. Say data security, compliance with government regulations, big data and AI integration, and blockchain integration. So my teammates would be continuing from here, and we'll be discussing deeply about these four areas.
Data security has been one of the main aspects that have been developed by fintech. The essence of this development is to create a safer environment for financial services transactions. However, there are always benefits and drawbacks to each creation. To begin with, let's talk about data security and how we define data security. Data security essentially means the protection of data, and in fintech it refers to the protection of digital data. The protection also means covering vital information from destructive forces and from unwanted actions of unauthorized users, like data breaches, for example, which we'll touch on later. The rise of fintech companies over the last decade means that there is also an increase in the level of regulations for each company, which brings new risks to the industry as well as opportunities. This also means that data security as a development is at risk as the number of users grow, meaning there will be more transactions to oversee. As a development, data security is important in the world of fintech for three main reasons. The first reason is it protects customers' personal and confidential information. There might be many applications where data security is integral, especially when we think of mobile banking, for example, where we may find very secure and sensitive information of the user. What data protection ensures is that even if unauthorized parties manage to access the data, they cannot view it or cause damages to it. Data protection methods ensure encryption, which prevents anyone from viewing data if they do not have a private encryption key, and data loss prevention mechanisms, which prevent users from transferring sensitive data outside the organization. Second importance of data security is that it minimizes data breaches. In the USA alone, there was $8 million recorded in data breaches, where 25,000 user accounts were impacted in the average data incident. This means that beyond financial losses, businesses are incurring several other losses, where most incidents lead to a loss of customer trust and a damage to their reputation, which also brings about another importance of data security, where it can protect companies against liabilities. For instance, protection against liabilities entails any lawsuits that could be filed against the business operations for a breach in security, which is why it is important to maintain the recent regulatory standards of data security that ensures that there are no liable parties. On the other hand, there are also risks created within data security, which introduces new problems. One of which are data losses, which could happen across unsecured networks when data is being shared. A second risk is through accidental exposure, where the development of fintech has made employees mishandle sensitive information at certain periods, which could result in sensitive data being revealed as a form of breach or a form of attack when organizations mishandle information. The third risk that could be created is via insider threats, which propose an additional form of risk, where sometimes employees may threaten to expose their organizations with sensitive information, which reflects poorly on the overall intent on data security and protection, indicating that further improvements need to be implemented where this shouldn't act as a threat to business operation and should reduce the flaws and liabilities to the organization. And finally, we have SQL injections, which is a common technique that is used by attackers to gain illicit access to databases and steal data and also perform unwanted operations. This can occur by adding malicious code to a seemingly innocent database query. To clarify further, the SQL injection generally manipulates the SQL code by adding special characters to the user input, which changes the whole context of the query, hence reflecting a high risk within data security. In this slide, we highlight certain examples of where some data security issues might arise, more specifically, data security breaches. We may think of the recent global pandemic as a catalyst that shifted customer preferences to digital and online transactions, which is why our first example refers to the increased use of contactless payments. This means, for obvious reasons, that customers are trying to minimize what they touch in public places, and one way to do so is through contactless payments, which could be via debit cards, Google Pay, and Apple Pay, for example. Where a breach might occur here is when the cryptograms embedded in the contactless payment system receives data that does not match the originator's mobile device. Another example is through traffic congestions. Given the rise of the fintech industry, more companies are emerging. In Europe alone, the fintech app usage is increased by 72% since the start of the pandemic. That means that there is more data to manage, more opportunities, and more storage locations that must be protected. This means a way for a breach to occur is through opportunities of attacking those storage locations, which may not be secure enough to store all of this information, given the rise in the amount of usage. And finally, there are also phishing attacks, which can be a way to harm fintech companies, mainly through phishing emails. For instance, phishing emails can be used in multiple ways to compromise fintech companies. One way is through password resetting, where hackers trick users into revealing their login credentials by pretending to reach out from the fintech company. Another way to do so is through account feeds, where often these emails encourage the user to share his or her credit card numbers over the phone, with the hacker being on the other end. These are main examples of security breaches that may occur in the fintech world, but mainly through data security, which is a development by fintech. By highlighting a specific jurisdiction, which is the United States, this graph represents the number of data breaches occurring, as well as the number of records being exposed during the years of 2005 to 2020. This graph illustrates that over the years, the number of data breaches has been increasing gradually. Even though there are massive dips, there is still a huge number of millions of records being exposed, which is really a concern for data security. In my personal opinion, data security has become a crucial topic within the industry, given the opportunities and risks it provides. I think that it is essentially important to maintain high standards of data security to protect all parties involved. This includes businesses and customers such as ourselves. Which is why I believe that the losses incurred could be minimized by implementing stricter regulations that oversee fintech companies as a whole, and fintech payment systems such as contactless payment systems, for example, and that is to oversee future growth in the foreseeable future.
Another issue that relates to the fintech industry is compliance with government regulations. Uh, the fintech, the finance industry is one of the most regulated industry, and financial regulation is a type of regulation or supervision that imposes particular rules, limits, and guidelines on financial institutions in order to protect financial system stability and integrity. These regulations may be imposed by the government or non-governmental agency that aims to protect the interests of customers and other stakeholders in the financial industry. The importance of regulations in the fintech industry involves protection of the interest of depositors by ensuring solvency, protect institutions from fraud and malicious attack. Another is ensure safe and transparent financial transaction, and also safeguard customers' investments and sensitive information. Regulations in the fintech industry ranges from capital requirements, anti-money laundering, privacy, and security. In the US, for example, there are several regulations that aims to protect institutions in the fintech industry. Some of the regulations involves the Federal Trade Commission, the GDPR, the Anti-Money Laundering Commission, the Anti-Money Laundering Regulations, and the Electronic Fund Transfer Act. Because fintech products are mostly used by customers, they need to follow the Federal Trade Commission's consumer protection standard. Fair business practices, privacy, and data protection are the major concern of this agency. The GLBA, which compels financial firms to disclose to customers how their data is handled and secured, is a crucial Federal Trade Commission rule for fintech firms. Another crucial rule that's important for the Federal Trade Commission is the Fair Credit Reporting Act, which establishes guidelines for business that collect credit information. Another regulation in the fintech industry is the GDPR. The GDPR, which is the General Data Protection Regulation, which lays out data management and privacy protection standards in the European Union, is one unique aspect regarding data privacy. Even if a fintech firm doesn't operate in the EU, this regulation applies to them as far as they store user data on EU individuals. Anti-money laundering regulations is another important law to consider in addition to customer protection and data privacy. The anti-money laundering is regulated in the US by the US Treasury's Bank Secrecy Act and the Patriot Act. This is a vital rule to address if a fintech firm is involved in cross-border transfer. Another regulation that in the fintech industry is the Electronic Fund Transfer Act, which aims to protect electronic payments transactions in the US. Although several regulatory advances have been made with respect to fintech, the constant innovation and development in the industry often give rise to the need for greater regulation. This creates issues for regulators in terms of constantly coming up with new regulations that protect various stakeholders in the industry. Also, most companies in the fintech industry do not consider themselves as doing the same business as the traditional financial institutions. So they do not follow the regulatory requirements that applies to the traditional financial institution. And non-compliance with regulatory requirements often leads to fintech firms being exposed to online fraudulent activities. One of the most common types of fraud in the fintech industry is online identity theft. Online fraud is the use of online services or some malicious software with internet access to defraud people or otherwise take advantage of them. Some of the most common fraud types include new account fraud and account takeover fraud. In the case of new account fraud, synthetic identities are created to start using online services. These identities are either fake, stolen, or modified from raw data or simply bought on the dark web. In the case of account takeover, criminals get access to people's accounts and start doing online transactions on their behalf. The figure in the slide represents fraud rates in the United States with regards to the fintech industry. From the figure, although there has been a decrease in fraud rates after May 2021, we can see fraud rates are starting to increase towards the end of 2021. Um, According to data from the IT Novarica Group, fintech companies like neobanks and robo advisors have an increase have an average fraud rate of roughly about 0.30%, and this is more than double the 0.15% to 0.20% fraud rate as seen with credit cards in the past, and three times greater than the 0.10% fraud rates as seen with debit cards. In 2020, identity fraud alone caused about 56 billion in losses across all US financial services firms. In my opinion, non-compliance with financial regulations in the fintech industry has caused a lot of problems in terms of protecting various stakeholders in the financial industry. And to solve this problem, I believe the current regulation in the I believe the current regulation with regards to the traditional financial institutions should be extended to the fintech firms. As long as people's deposits or people's investments are involved, there'll be risks involved, and there should be regulation that aims to protect these stakeholders in the fintech industry.
Now let's talk about blockchain integration. Blockchain is a network software protocol that enables the secure transfer of money, assets, and information via the internet without the need for the third party intermediary such as banks. It can safely store transactions such as digital cryptocurrencies or other data such as information about debt, copyrights, equity, and digital assets in general. The stored information cannot be easily forged and tampered with, as that would involve individual approval of all distributed nodes. Now we'll talk about the roles of blockchain in democratizing finance. Blockchain has the potential to make the financial service industry more transparent, less susceptible to fraud, and cheaper for consumers. We'll talk about main three areas that are improving transparency. Blockchain can make the financial industry more transparent since users are performing activities on a public ledger. This transparency can expose inefficiencies like fraud, leading to problem solving that could reduce the risk for financial institutions. Adding security. As consumers become increasingly active online, the digital universe is breeding ground for scammers. With blockchain technology, this concern would be reduced. Payments and money transfer made on blockchain are faster and more traceable than in traditional banking, lowering costs. As investors move away from the financial advisors toward higher fees, blockchain provides an opportunity for consumers to benefit from lower costs associated with traditional financial services. Let us move forward and discuss challenges with blockchain integration. As we know, blockchain is quite new technology. So, people with great knowledge and expertise are required to implement this type of system. So, at this point of time, it is very difficult to implement and maintain these types of system. Weighing it against the promise blockchain holds for financial institution, it is one of the major risks affecting the bottom line of this institutions. Traditional financial institutions make money on transaction fees that could be lowered or eliminated with blockchain technology. When it comes to transferring money, consumers have to rely on banks or third parties to process transactions, but adoption of blockchain would bypass these third parties such as banks, which would eliminate fees and other costs associated with these services. As a result, bank may face challenges in volume and transaction based revenue. As we know, banks are right now the backbone of the economy, so it is quite difficult to maintain this. Blockchain makes the infrastructure that's proprietary to financial institution less important because it serves as a verification mechanism that's not concentrated in the power of one institution. In addition, blockchain innovation is moving so fast that regulation hasn't caught up yet. So the potential policies impacting blockchain can be seen as another obstacle in the incorporating blockchain in financial services. Existing regulation does present a significant obstacle for blockchain adoption since regulator will prioritize existing incumbents over disruptors. Regulators are working through determining the pros and cons of this system, blockchain technology, to see if it's suitable for financial institutions and what the consequences are for companies and consumers. Despite the challenges, some countries have started adopting blockchain technology. Let us discuss about few of them. United Kingdom have welfare payment and student loan system. On August 3rd, 2016, through UK government's Innovative UK, blockchain as a service was launched for purpose. As it stands, the blockchain is used for paying welfare checks and disbursing student loans. However, the application of BAS is not limited to these two services. Any government agency in the UK is allowed to purchase it. Then further services can be built and deployed to the general public. The involvement of the Department for Work and Pension is the most notable one. Started in 2016, the department allowed pensioners to claim payments through a mobile app that is blockchain supported. Singapore. Finance Department of Singapore, as of October 13, 2017, interbank payments are made in Singapore using the blockchain concept. Through a partnership between Monetary Authority of Singapore and Consortium of Financial Institutions. Project Ubin takes the lead in a greater strategy to adopt blockchain in Singapore's financial sector. The government plans to tokenize the state's currency on the Ethereum network. The authority also announced an allocation of over $225 million to blockchain research and development. The next one is Venezuela Petrocoin. At the dawn of 2018, Venezuela declared Petrocoin as their primary currency. This was in an effort to phase out the Bolivia, which was going through the record setting inflation. Petrocoin is oil based, which used coin backed with the oil reserves in the country. The coin runs on the NEM blockchain despite the white paper stating the coin is an ERC20 token on Ethereum. The coin has been under fire for its gray areas and expectations to rescue a failed economy are in question. However, Business Analytics says there is a potential in Petrocoin growth. By this, we can understand that there is a huge scope in this technology. It is just the start of evolvement of this technology. So, further going, we would see some great ideas and innovations bringing the great disruptions in financial sector.
Hello, I am Ravi Prakash Janu and I am going to continue with the big data and AI session of our presentation. I'm going to talk about what big data and AI mean and its advantage and applications, how it play an important role in democratizing the financial system, and some problem creating due to this technology, and support the argument with a real-time example. Okay. So, what is the big data and AI? Big data and AI intelligence are literally an superpower computing system. Big data refers to input and raw material that artificial intelligence used to analyze and generating insight and a useful decision. Big data use large data set that can be anything from collection. By programming AI to absorb the different type of a data, it can then effectively come up with the solutions, make a decision and range of a different topics. The main goal of AI system is to identify the pattern, accomplish the task the human was previously doing. These are helpful in the business that adapt the technologies are performing tasks in a higher standard at a quick speed through automation. Examples like Netflix is using insight generation by the big data to produce and recommendation content that user enjoy based on their previous history. Here are the few advantage of big data what I'm going to talk about. Like big data can make a better and data driven decisions that directly increase their profits by effective targeting or spot on a recommendation, reduce customers blender by identifying the hesitating customer early, automating representative tasks that AI can do much faster than a human employees. How big data and AI helps in financial service? Here are few of the applications. Credit scoring. Many financial institute, large bank or small financial company are in the business of lending money, and to do so they need a accurate access of credit worthiness of individual and company. Traditionally such decisions were made by the analyst by taking their interview and gathering their data. However, artificial intelligence allows same process faster and more accurate and with a more complex method, which provide a better unbiased decision based on their past financial data. Fraud prevention. Due to increase in popularity of e-commerce, the number of online traditions and third-party integration fakeness has been increased. Machine learning can make a tremendous understanding of such a fraudulent activities such as a credit card fraud, money laundering, etc. Algorithmic trading. Faster pattern identification leads to a better decision in trading system. When some kind of a pattern is identified and market react, it's already too late to action and opportunity has gone. That is why so many efforts on and money is invested in algorithmic trading, such as system can greatly outperform human trading system. Robo advisory provided wealth management services in AI put together portfolio recommendation based on the investor's individual goals, their risk preference and their income. Chatbot system replace the call center service by chatting system which provide a helps to user change their password, check their current balance, schedule transaction, etc. Additionally, such chatbot system can often recognize the customer's emotions and adjust their response based on their emotions. Personalized banking experience. The banking sector tries to harness the power of AI to provide a personalized banking experience to everyone. Institutions leverage the vast amount of data they can analyze the customer spending behavior and provide the tailored financial advice which can help to achieve their goal. Issue arises with the big data and AI integration. First, data quality. The prediction power of an algorithm is highly dependent upon the quality of a data fed as an input. Even in quality sources, bias can hidden in the data. The time and effort required to gather and prepare an appropriate set of data should not be underestimated. Black box effect. The result of intelligent algorithms are not be verified, but delivering The statistical truth means that they can be wrong in individual. The diagnostic and correcting of these algorithm is very complex. Narrow focus. By design, intelligent algorithms are good at solving specific problem, cannot solve the different one. An algorithm training to detect a suspicious payment would not be able to detect any other suspicious activities such as trading issues. Responsibility. Financial decisions are crucial. It is difficult to give a machine full control because their behavior is not fully surprised sometimes. Human supervisions to be validate the machine's decision for a critical activity are required, such as releasing and blocking payment of validate traders participating defecting. The purpose of using machines is the first place. AI and big data firm real example of a success and failure. First, Bank of America. They have their own chat box called Eric, which is debuted in 2018, which serve more than 10 million users, and it understands almost 5 million question variations. JP Morgan has fraud detection application system, including the implementing an algorithm to detect a fault pattern. According to Business Insider, detail of a credit card transaction are sent to the data center, which decide whether the transactions are fraud or not. One of the failure example is like a lawsuit was filed as a result of a AI failure. A Hong Kong real estate tycoon purchased a AI system from a firm to increase his investment money. In reality, the robot continued to lose up to 20 millions every day. He reclaimed a portion of his money. That tycoon sued the firm that provided the fintech service for 23 million. Wong UK-based company provided short-term online cash loan for British customer. Unfortunately, the company AI was lend out of money to the people that can't afford to repay loan. As a result, company ended up in 2018, which provided a loan to 3,030 clients. Those are failed to repay. Out of that, 45,000 clients are failed to repay.
Thanks to the rapid development of technology over the past 30 years, the fintech industry has been able to massively grow into a prominent force. Since the financial crisis in 2007, there has been an increase in demand for consumers to have greater transparency and control over their finances, whilst also taking away power from the traditional brick-and-mortar institutions. Regulators have also implemented new regulations in order to try and prevent a crisis such as this occurring again. Fintech has the goal of improving customer experience and removing barriers in an industry which has traditionally been extremely slow to adapt. Thus, the democratization of finance is due to a global demand to completely rethink how the financial industry is run and make it more accessible to everyone, regardless of their background. There have been many benefits to both consumers and companies resulting from the democratization of finance. It has created opportunities for the underbanked communities. It has created opportunities for underbanked communities to access financial services which previously they could not access. This has allowed for consumers to have a greater control over their finances and increase their financial security. Financial institutions have benefited from the rise of big data and the technology used to analyze it. The use of AI and machine learning has allowed for firms to create a more detailed picture of investment opportunities and the risks associated with it. Also, these technologies have helped to replace systems which were previously large manual processes, thus creating a faster and cheaper process which can be used to deal that is used to deal with greater sums of data. However, there is a reason why traditional institutions have always been slow to innovate and adapt. That is due to the risk involved. With change comes risk. As these new technologies have not been tested, there is little knowledge of how safe they are in different economic environments. As firms are increasingly quick to take up innovative products, it is difficult for regulators to adapt and monitor these new tools. But furthermore, with greater amounts of data being shared, it is increasingly more dangerous that there will be a large data breach. Overall, the democratization of financial services has created large benefits for both consumers and businesses, increasing opportunity, scale, flexibility, and transparency, whilst creating a whole range of new products and services. And it's here to stay, but this rapid change being implemented by fintech has given rise to a new type of risk, which a regulator and businesses are unprepared for. Thus, it is necessary that regulators attempt to keep on top of and work with these new businesses to create a minimal risk environment. Furthermore, as it is in the best interest for fintech firms to mitigate and avoid these risks, they are developing and using tools which should help in this process. The use of technologies such as blockchain should help to further facilitate the security of this new environment.